All right, everyone, we are at the top of the hour, so I'm going to go ahead and get started. Thank you so much for being here today. I see a lot of familiar names that come to these on a regular basis. I see some new names in there, actually a lot more new names than usual. Taxes must be a hot topic. Nobody likes paying them, so I guess everybody wants to find out more information on it, right? For those of you who don't know me, I'll introduce myself. My name is Sam Rodriguez. I am a certified financial planner. I'm the co-founder of Foundation Wealth Partners, founded Foundation Wealth Partners a few years ago, really with the idea of being able to help clients in a more comprehensive way. And one of the things that is important to us, and one of the reasons that I do these bi-weekly webinars, is it's important to us that you understand what it is that you should be thinking about when it comes to your personal financial situation, right? I think as advisors, most of the time you find that they talk with you about your investments, and that may be just about it. Maybe they'll do a little bit of goal planning, telling you whether or not you can retire, but there's so much more that should go into it, right? Your financial life encompasses so much more than that, and these are things that you should be thinking about. Taxes especially is one of them. This topic is very important, right? When we think about our retirement in particular, we often think of our income versus expenses when we are trying to figure out how long our money is going to last. And really, we should be thinking about taxes as an expense, right? We control every other expense we have. We control how much we pay at the grocery store, how much we pay in gas, how much we pay going out. We should see what we can control when it comes to taxes. And that's what today is about. Today is about talking about how taxes work, especially during retirement, and what you might be able to do to help control that a little bit. So with that, I'm going to go ahead and get started. Before though, of course, I have to show you the mandatory disclosures. Keep in mind, I am a certified financial planner. I'm not a CPA or an enrolled agent or attorney. So the contents of the presentation really are just based on things that we see when we're helping clients on a day-to-day basis, and they're not specific advice for any particular situation. With that being said, there is a very practical aspect to your taxes. So many of the decisions that you're going to be making are going to have tax implications, and whether or not you use a professional to look forward at those to those implications is another story. So my goal today is for you to leave here with a better understanding of how taxes are different in retirement than they were when you were working, and to also help you avoid some very common pitfalls that we see. And so I'll discuss how the Tax Cuts and Job Acts of 2017 change things, and how those changes impact many of the decisions you're going to be making. I am going to limit the topic today to what is, in other words, what we know right now. Of course, there are some tax items on the agenda with the current administration, but I'm going to stay away from that. And like I said, and just talk about what is. I'm also going to really just stay away from the political and stick to the actionable items, right? One note before we get started, I am going to focus on married filing jointly statistics, because that's what we see most often. But for those of you who have different filing statuses, know that the principles that you're going to see in here still remain the same. But for time purposes, I'm not going to run through every single filing status. I'm just going to run through what we see most often, but these things still apply to you. So in theory, our tax system is pretty straightforward. And it is very similar to the way the system was before the Tax Cuts and Job Acts of 2017. I guess what I should say, when you look at this table, as you go up in income, the rate you pay also goes up, right? And these brackets are new compared to what they were, right? The new brackets have lower rates at each step, which is why most people will pay less taxes under this system than they were before the Tax Cut and Jobs Act. right? So this tax structure is specifically for ordinary income. So ordinary income includes like your wages, IRA withdrawals, 401k withdrawals, pension income, and also interest. And some of you may have filled out a paper tax form before. And if you have, you've probably seen a more complete version of the bracket system, which looks a lot more like what you see on the screen right now, right? You have a base amount and then the rate for the amount above. And when people fill out paper forms, this representation really makes it much easier to realize that it's only the income that falls into a given tax bracket that's actually taxed at that rate. And this might be an easier way to visualize the way tax brackets work. We call it a tax map because it really illustrates the rate at which each additional dollar of ordinary income would be taxed. So in retirement, two of the most common sources of ordinary income that we see are pension income and withdrawals from IRA accounts. So notice that from 0 to about 27,800, there's no taxes owed. And that's due to the much larger standard deduction that you have now. Plus, in this example, excuse me, in this example, we're using 65-year-olds who have an additional $1,350 each because they're over age 65, which I'll discuss that more here in a few slides. And then from 27,800 to just over 47,000, your income falls into the 10% bracket. So only the income that falls in that range actually gets taxed at 10%. So for the income that falls between about 47,000 and 108,850, that's only taxed at 12%. So if those ranges seem odd to you, if those seem like, hey, almost $109,000 at 12%, if that seems odd, it's because of the new higher standard deduction that's in place. And I'll discuss that in more detail here in a little bit. Something I want to point out, though, there are two spots on this map worth really paying attention to because there are big jumps. So the jump from 0 to 10, and then again from 12 to 22, and then the jump from 24 to 32. Those are where the biggest opportunities for tax planning are. And that brings me to something that's very important to understand, and that is the concept of marginal tax rates. So your marginal rate is the rate you paid on the very last dollar of income you received, which is typically that highest tax bracket that you fell into, right? But we need to factor in capital gains and qualified dividends as well. And they have their own brackets that are separate from ordinary income. And these brackets are lower, and that's primarily because the government really is trying to incentivize us or encourage us to invest in the economy. And there's still a marginal tax concept for capital gains and dividends, but the brackets are considerably different, right? So if I were to ask you guys, what rate are capital gains taxed at? Most of the time when I ask that, people aren't sure. At most, they say 15%, but they actually have their own marginal structure, right? So notice that 15% capital gains bracket kind of roughly aligns with the ordinary income bracket from before. So what happens is your long-term capital gains and qualified dividends that would fall into the 10 or 12% ordinary income bracket on the previous bracket, they actually come through at a 0% rate, right? And the reason is that the old capital gain system, we basically left that behind with this new tax bill. So there's a pretty good amount of capital gains you can receive at actually a 0% tax rate. You only get up to that 15% capital gains rate for gains that would fall into the 22% bracket on the ordinary income. So here, that's a pretty wide range. You can see it's from $80,801 to over $500,000, right? And then there is a 20% capital gains rate, but that only applies when you cross over that $501,000 threshold, right? That's where the old 39.6% ordinary income bracket would have begun. So the tax bill didn't dramatically change capital gain opportunities for high income earners, but it is important to understand how this works. And even though 15% is sort of a rule of thumb, it really doesn't hold true all of the time. So here's a tax map when it comes to dividends and capital gains. Now, if all you had were dividends and capital gains on your tax return, you would pay 0% until you had enough to fill that 12% ordinary income tax bracket, right? And for taxpayers in the highest ordinary income bracket, the capital gains rate is 20, like I was pointing out before. And this is a really important concept because it shows how capital gains taxation is actually linked to your ordinary income. So once the combination of capital gains plus whatever your ordinary income is pushes you above that threshold, that really about $109,000 threshold, then your capital gains become taxable at 15%. So this structure really didn't change under the last tax bill, but because of a new larger standard deduction, the range at which it impacts you changed dramatically. Which really brings me to the changes that happened in deductions, exemptions, and credits. So these reduce your federal tax bill, right? Effectively making the first several $1,000s of your household tax-free. And you can think of deductions as reductions to income for certain things you spend money on. You can either track those things such as mortgage interest, investment interest, and then you can complete a Schedule A or itemize, right? Or you can decide to take the standard deduction, which was increased pretty substantially. So in 2017, it was $13,000 for a couple. But now that standard deduction is over $25,000. So it's commonly estimated that less than 15% of the population will actually benefit from itemizing. And for many retired taxpayers, even before the increase, there simply just weren't enough deductions for it to make sense for them to itemize on a Schedule A. And once you reach age 65, or if you're blind, you can get an additional deduction of $1,350 each if you're married, or $1,700 if you're single. And this provision stayed with the new tax law and increased $50 actually from where it was back in 2020. So what did change, right? The personal exemption was eliminated in 2018. In general, for a couple, previously, the combination of that personal exemption plus the lower standard deductions that were in place, they still would have been less than the new standard deduction. So deductions and exemptions, though, they reduce your taxable income, and that indirectly reduces your tax. So credits, on the other hand, directly reduce your tax bill. So tax credits are specifically designed to incentivize certain behaviors. And two of the most common tax credits are the healthcare tax credit and the earned income tax credit. A less common one, but one that can be accessed by some people who maybe work part-time in retirement, is what's called the Savers Credit. And it basically incentivizes lower income people to save into retirement accounts. One thing I want to point out, though, remember, even if you've been a high income earner all of your life, your tax return could be set up to present you as a low earner between that point when you formally retire and that point in time when you're forced to begin taking required minimum distributions from your IRA accounts. And that's where the opportunity for the retirement savers credit comes into play. So here's an example. This is an example of a couple that with $38,000 of gross earned income. That is all ordinary income, right? At least 2,000 of the income must be in the form of wages, right? So I said earned gross income. I shouldn't have said that. I should have just said ordinary income, which could also mean it's from pensions or IRAs. But if at least 2,000 of that income came in the form of wages, maybe from some part-time work, well, what you see here is first we reduce that income by the standard deduction for a married couple, plus that deduction for being age 65 or older. And then we take the $2,000 off for a combined or for a contribution to a traditional IRA to come up with our taxable income of $8,200. So instead of it being $38,000 taxable, it's only $8,200 taxable. So notice how the deductions reduce the taxable income. And then we multiply that times 10, since all of that income falls into the 10% bracket for a total tax bill of $820. Not too bad on $38,000 of income. But remember, credits are different than deductions and exemptions in that they directly reduce the tax bill. So in this case, the saver's credit results in a $1,000 tax credit, taking the total federal tax bill for these clients down to zero. So $38,000 of income with zero tax. So why is it only zero and you didn't get a refund of $180 if they had a credit of $1,000 and the taxes owed was only $820? And that's because credits are non-refundable, right? They can only reduce the tax bill. And remember how our tax map a little bit ago showed no tax up to $27,800, right? That was the impact of the new higher standard deduction plus the deduction for being over 65. So realistically, if that were all there was to our tax system, it would be relatively easy, relatively intuitive. But unfortunately, in retirement, we see several complicating factors, and each of them that you see on the screen right now really creates an environment where what you expect to pay may not actually be what you end up paying. And I'll dig into that here in this next section. So the first complicating factor is required minimum distributions. So most of our clients have saved pretty significantly into things like a 401k or IRA over the years. And generally, these contributions were pre-taxed on the front end. So what happens is all of those withdrawals, when you take them out, are going to be taxed as ordinary income. And once you reach age 72, you are going to be forced to begin taking withdrawals. And the process for calculating these withdrawals is relatively straightforward. Each year, you take the ending balance for the prior year and you divide it by a factor representing your remaining life expectancy. And here on the screen, you see an example of that calculation where $500,000 balance was divided by 25.6 being the life expectancy years, showing a total needed withdrawal of $19,531. How do you find your life expectancy? The IRS provides us a table, and it's called a uniform lifetime table. But notice here that each year, as you age, your life expectancy goes down by less than 1 year, such that the table runs all the way to age 115. And even at age 115, you only have to take out a little more than half of the prior year's ending balance. No big deal, right? But the key here is that if you've done a good job saving in your IRA, the minimum distributions that they're going to make you take out, plus your Social Security, may actually be more than you need to sustain the lifestyle you want to live. And if that's going to be the case, it's likely you're going to have to pay more taxes on the back end than you should be. Right now, I'll show you what I mean here in a few slides. But we also have to factor in capital gains into this situation. So when you think of capital gains, if you're like many people, like I said before, you think that 15%, and that's only when I sell something that has appreciated. Well, it's not only when you sell something. one thing you have to be aware of and concerned about is something we call phantom gain. And what many people don't realize is that you can recognize capital gains even if you didn't sell anything, particularly if you own mutual funds. And that's where that phantom gain comes in. So I'm going to kind of give you an example to illustrate it. So let's say mutual fund ABC, yeah, right? They bought Apple stock back in 1985. And then you bought that mutual fund ABC in 2019 and held it all the way, let's say you're still holding it right now. But let's say in the middle of 2021, the fund manager of fund ABC decides to sell the Apple stock that they're holding. And they sell the entire position. Well, any gain that was recognized on the sale, right? The gain from 1985 to 2021, that has to be passed on to individuals like yourself who own that mutual fund, even if you didn't participate in any of the gain before you bought that mutual fund. So the important thing to remember about capital gains is that if you have invested money that is not in an IRA or a 401k into one of these mutual funds, even if you are generally kind of a buy and hold type of investor, it's likely you're going to recognize some capital gains in most years. And more importantly, when you experience a capital gain on your return, it can have a greater impact than just the tax on the gain because it increases your adjusted gross income overall. And it may cause some of the other deductions you were receiving or exclusions that you were getting to be phased out. Oh, I kind of skipped over something. So a really good example of this, of the sort of counterintuitive nature of how your required minimum distributions interact with your capital gains and end up creating ordinary income, is by the way of how Social Security is taxed. Now, if all you had on your tax return was Social Security, you would owe no federal income tax at all. But when you have other types of income, it can cause your Social Security to be taxable. So it's common for advisors to tell clients that 85% of your Social Security is going to be taxable. And that could be true, but it's not always true. For high income people, 85% is often taxable and 15% of your Social Security is tax-free. But for middle and upper middle income folks, that is often not true because it's based on a formula called the provisional income formula. And that can have some strange impacts. So I'm going to walk you through how that happens. So your provisional income, it includes half of your Social Security benefits plus plus all of your other taxable income. So that includes your ordinary income, dividends and capital gains, interest, plus non-taxable interest earnings, right? Such as things from municipal bonds. So a lot of times people think, well, municipal bonds aren't taxable, doesn't impact me at all, but it could impact how much of your Social Security is taxed. So once we've calculated what your provisional income is, we have to apply these thresholds. So at the top, you see the thresholds for a single filer and at the bottom for a married couple filing jointly. The key here is that only the provisional income that falls over these thresholds creates taxable Social Security. So the best way to demonstrate how this works is to show you an example. So we'll do two examples, both of which have $60,000 of household income. So in the first, we have $20,000 of Social Security income and $40,000 of IRA withdrawals. So what we do is we take half of the Social Security and we add that to the IRA withdrawals, and we come up with $50,000 of provisional income. Then we apply the first threshold. So for a married couple, That's $32,000. So we're $18,000 over that threshold, and 50 cents of each benefit dollar over the threshold becomes taxable. Oops, I jumped ahead just a little bit. So we have 9,000 of taxable Social Security here. Now we apply the second threshold, which is 44,000. So we're 6,000 over that threshold, and 85 cents of every dollar becomes taxable here. So that creates an additional $2,100 of taxable income. So we already picked up the first 50 cents of each dollar in step one, which is why we only multiply by 0.35 here in the second step. So in other words, even though we have 60,000 of household income, only 55% of the Social Security benefit is taxable. But now let's take a look at the other example that I accidentally showed a second ago. We have 60,000 of household income, but in this one we have 40,000 of Social Security instead of 20, and 20,000 from an IRA withdrawal. So we flipped it. Instead of 40 from Social Security and 20 from IRA, we now have 20,000 from Social Security, and 40,000 from Social Security and 20,000 from an IRA withdrawal. So we now take half the Social Security and add it to the IRA withdrawal to get your provisional income of 40,000. So that puts us 8,000 over that first threshold. So that creates 4,000 of taxable income, but we're still under that second threshold. So 40,000 of Social Security income. 36,000 of that is tax-free, and only 10% of the Social Security benefit is taxable. So here you can see the impact of where your money comes from, even though you're withdrawing the same amount, has an impact as to how much of your Social Security is taxable. And when we bring those numbers onto the tax return, we see it a bit more clearly. The $40,000 IRA and $20,000 Social Security blend results in $2,398 of federal income tax. But that opposite blend, that was 20 of Social Security and 40 from the IRA, creates no federal income tax at all. So now we've covered the most common ways, things that create both confusion, but they also create opportunity around taxes and retirement. And these last few are things that impact higher income people primarily, but they could impact you in a year where maybe you do some big Roth conversions, or maybe it's going to be a year in retirement where you do a lot of traveling, you have a large unusual expense maybe, and you've got to use more of your money. And so what happens is Medicare is now what's called means tested. And these thresholds include your full Social Security benefit. So if you fall over the threshold, you end up paying an extra Medicare Part B and D premium. So in the scope of your total tax bill, it's probably not much, but it's not insignificant either. So these premiums are based on your income from 2 years ago. So it's worth paying attention to the thresholds as you consider how much to take from your various accounts. And there is a 3.8% net investment income tax that also impacts higher income taxpayers, right? It creates an additional 3.8% tax on net investment income, which includes capital gains and dividends, interest, and annuity payments. It also does include passive business income and rental income. So basically, if it's not derived from work or like investment returns, and it falls over the 200,000 or 250,000 of adjusted gross income threshold, it's likely going to be subject to the 3.8% additional taxes. So here's a significant change that is a result of the Tax Cuts and Jobs Act. The PEP and Ps, they are now gone. Now that there are no personal exemptions, there's nothing to phase out. And since the value of itemized deductions was reduced because of the higher standard deduction, the P's limitation was also eliminated by that act. And the final distortion, again, it really applies only for people who have higher incomes and a lot of deductions. And it's called the alternative minimum tax. And it's this flat rate tax system that runs parallel to our normal tax system. And prior to the tax reform in 2017, it was estimated that fewer than 4 million taxpayers were actually subject to AMT, or alternative minimum tax. But that tax reform actually significantly increased the thresholds and the phased outs that were related to AMT. So it actually is going to apply to very few retired people moving forward, as long as this is the way it stays. So if you are subject to AMT, odds are you probably already know it. And this is definitely an area to work with your CPA for tax advice on. So the complications I've just talked about, they should highlight just one major point. Over time, when government has needed new revenue, the method has not been to change the rates or to change the brackets, to make sort of an even new tax for all taxpayers. Instead, what happens, they introduce phase outs of deductions that exist, or they phase out exemptions, or they begin to include income that previously was not taxable, like the Social Security example that I showed you. And the result is a tax system in which the most important number isn't necessarily the tax bracket that you land in, but instead it's your what's called effective marginal tax rate. So in other words, how much of your last dollar did you actually lose because you had to pay taxes on it? So let's show you the tax map again. So remember, as you increase your ordinary income from left to right, you can see that the rate should intuitively be applied to the next dollar. And here's that same map for capital gains. Again, intuitively, we think, yeah, as we rise in income, that's the rate that we have to pay on the next dollar that we were to receive. But I want to do a quick case study to illustrate the idea of effective marginal rates. So we have John and Jane. They are married filing jointly, and they're both over 65. And they have $61,000 of combined Social Security income. They also have $10,000 of long-term capital gains this year, and they withdrew $52,000 from their IRA. Here's their tax map. So you can see that once they harvest a little over $10,000 in ordinary income, they actually begin to experience an 18.6% effective marginal tax rate. So this is the point that their ordinary income plus their capital gains end up dragging enough Social Security into the calculation to begin making every additional dollar that's withdrawn from the IRA taxable at 10%. And each additional dollar over that drags another 85 cents of Social Security into the mix. And what that ends up doing is creating an effective marginal rate of 18.6%. So you can see this couple never really experiences that 10 or 12% tax bracket. They go from 18.6 to 22.2 to almost 50% before they drop back down into the regular tax brackets. If you're saying, wait a second, hold on a minute, I'm not understanding, where'd that spike that occurred at the 12% tax bracket, how in the world did that happen? You're not alone, right? Because intuitively, this is a couple that's in the 12% tax bracket for ordinary income. And you would think, oh, if I pulled so let's say I pulled $1,000 to create, in the 12% tax bracket, that would only create 120,000 or $120 of taxes. But here's what actually happened. That $1,000 withdrawal did get taxed at 12% for $120, right? But then it caused $850 of Social Security benefits to become taxable. And that added $102 to the tax bill, which then together caused $1,850 of capital gains that would have come through at 0%. Well, now it's suddenly taxable. And that results in an additional $277.50 in federal income tax. So in short, that $1,000 that the couple took out, they ended up losing $499.50 of it to federal income tax because of everything else that got pulled in. So when I showed that almost 50% tax bracket that they were in for a minute, that's where that came from. It was the next dollar they pulled, they were going to lose quite a bit of that to taxes because of everything that got pulled into the situation. So you have a very similar effect when it comes to capital gains. If the couple were choosing whether or not to sell a stock that maybe has, say, 25,000 of gains this year, they would certainly want to know that on a portion of that sale, they were actually going to lose quite a bit to federal income tax. And maybe it makes sense to only sell part of the position this year to avoid that big spike. So the fact is, there's a lot of ways to control your taxes and to plan in advance to create tax efficient retirements. And diversifying among different account types that have different tax treatment, using tax deferred products where appropriate, blending withdrawals from different account types rather than just simply, taking from all one type of account, and really paying close attention to which types of investments you hold in which accounts can all make a difference in the tax efficiency of your retirement income. So I want to talk about some of the latest changes that happened with the Secure Act. And I'm going to go through these really quickly. I've added these to the end because they are important. And the first important change related to the Secure Act was the increase in the beginning date for required minimum distributions. I mentioned earlier it was 72. That might have been a surprise for some of you because prior to the Secure Act last year, a couple of years ago, the first year of RMDs or required minimum distributions was the year when you reached age 70 and a half. So what happened with the Secure Act is they changed that age to age 72. And what that does is it creates an additional year and a half of IRA deferral. But that may also create additional time in which you consider things like Roth IRA conversions. The second change is really significant, and particularly for those of you who have large IRAs that you are planning to leave to your children. Prior to the Secure Act, when your children inherited this money, they could stretch the withdrawals of that IRA over their lifetime. So the way it worked is you passed your money on and your children inherited the money, but they would have to begin taking required minimum distributions. And they would have a very similar life expectancy table as to what I showed earlier. But they'd be able to stretch it out over their lifetime, taking small amounts every year, not having a huge impact to their tax situation. But now all funds from inherited IRAs for most beneficiaries, they've got to be distributed within 10 years. So there is complete flexibility as to how those are distributed during the 10 years. So in other words, you could distribute it all in 1 year, or you could do 10 or portions in any given year, but the account has to be fully emptied by the end of the 10th year. And there are very few exceptions to that rule. But for most beneficiaries, right, plan on the 10-year rule being in effect. And when you look at the impact of these two things together, people with large IRAs will likely accumulate a greater amount in their IRAs than they would have under the previous law. And the challenge is that when your required minimum distributions begin, they're also going to be for a larger amount because you got to defer things longer. And if they are actually more than you need in order to keep up your lifestyle, then that excess is going to be taxed much, you're going to end up paying much more taxes than you want because you have to pull more money out. Even further than that, when your beneficiaries inherit those funds, it's likely that when you're, I don't want to say kids, though they're probably adults by now, right? When your children inherit that money, it's quite possible that they're going to be in their highest income earning years, meaning their tax liability could be very significant when they have to start pulling that money out from required minimum distributions on the inherited IRA that they received. So thinking about your IRA, it's very important to plan out how those withdrawals happen, where you pull your money from in terms of your differing accounts to control your tax situation, but also to help control what gets passed on to your kids and think about their taxable situation. So a third major change is the removal of the age limitation for deductible IRA contributions. So prior to the Secure Act, IRA contributions could not be made after age 70 and a half. So in other words, once you had to start taking your required minimum distributions, you were no longer able to contribute to an IRA and get the deduction. Now you're actually able to make those contributions at any age. So as long as you or your spouse has some earned income in that tax year, you can make a contribution. And this is important because many retirees may work part-time, right? I'm finding more and more of my clients, maybe they're not fully retired, but they're kind of doing the same work they were doing before, but on more of a consulting basis, and having a lot more free time to themselves. Well, if you are still working, you can now take some of that money and contribute to an IRA and potentially even qualify for an additional tax credit that I was talking about before called the Savers Credit. And the Savers Credit is a non-refundable tax credit for up to 50 cents on the dollar for each dollar that you contribute to an IRA, up to a credit amount of $1,000 or $2,000 for a married couple filing jointly. And the fact really is that these maps, these tax maps, they're going to look completely different depending on your specific situation. And for those of you that already work with one of our advisors, this is something that we're always paying attention to for you. But for those of you who do not work with us, or, if you'd like to know what your retirement tax situation will look like or does look like, and what could be done to improve it, please email me. My email is srodriguez@foundationwealthpartners.com. And either myself or one of our advisors will schedule some time to visit with you about your situation. If there's anybody who could probably benefit from looking at how this works and thinking about taxes as an expense in retirement, this is going to be available for replay. Feel free to share it with them so they can watch it. But I encourage you, if you don't already work with us, find some time with us and we'll go through this with you and tell you what it looks like for your particular situation. Thanks, guys, for attending. Really appreciate you. All of you are going to receive emails, of course, on the next webinar that we do. It's escaping my mind right now what it is, but we'll make sure to get that out to you. Thanks a lot, guys.